All right, hello and welcome back to my finance channel where we talk about all things money, right? I am primarily an index fund and dividend investor, more so dividend investor. And I promise you, all right, that you are safe here. All right, I promise you that you are safe here. I don't have any kind of overpriced BS courses to sell y'all. I am not some millionaire investor who already has millions of dollars invested into the market. I represent the everyday average working American who is trying to make life just a little bit easier by securing some type of financial independence, okay? I promise you. I promise you. And now that we've got the introductions out of the way, what in the world is going on with Starbucks stock? I used to own Starbucks stock. I don't any longer because I sold it. And I'm glad I did. But listen, we're talking about a Class A company here with the number one coffee brand, not just in the United States, but the number one coffee brand in the entire world. And it ain't close. Largest coffee chain in the entire world, bringing in an annual revenue of nearly $36 billion. That's capital B, ladies and gentlemen. Starbucks is no slouch. So then if that's the case, right, then how is it such a lucrative and worldwide brand is down over 20% year to date in the stock market and has been largely unimpactful over the course of the last 5 years in the market? Well, let's get a little context from the people that study these things on a daily basis, shall we?
Starbucks, disappointing here, both on the bottom and on the top line. This is the fiscal second quarter for Starbucks that's just reported. Adjusted earnings per share at 68 cents, 12 cents shy of analyst estimates, and second quarter comparable sales down 4%. Analysts had been looking for a gain of 1.5%. And looking through the different regions here, it looks like it was disappointing across the board, but particularly so in China. Comp sales in China for Starbucks down 11% versus the 1.6% drop that analysts on average were predicting. International overall down 6%, North America down 3%, and U.S. down 3%. So really quite surprising numbers from Starbucks.
Yeah, I mean, the stock is really sinking here in the after hours, and for good reason, Julie, because you just noted, I mean, there's just misses all over this print. I think, listen, some questions about inflation, price increases. China really stands out. I'm seeing Q2 China comp sales down 11%. That really misses what the street was looking for there. So what is going on there? Is that the shaky economy? Is that the home team maybe taking a bite here in terms of competitive pressure? That'll be a big focus on the call. Also, I mean, you want to hear more about California boosting the minimum wage for fast food workers. I think they went to 20 an hour. So lots of misses all over this print, which I think explains at least the initial reaction here after hours.
Yes, exactly. And, you know, if you're looking for what happened here in the quarter, you will not find it. Well, actually, I was looking at the release, but it was the last quarter's release. So I was trying to look for some commentary here on what might have happened, but not seeing it. But it is notable, I think, that you are seeing a pullback, not just in one market for Starbucks, but really across the board. So I'm really curious, to your point, what's that about? Is it that people are trying to save money and that they're not going to Starbucks, whether it be in China or in the United States? So obviously we'll dig into that a little bit, but it is unusual to see this kind of a disappointment from Starbucks. I'm just doing a quick look here to see what their history has looked like. It looks like this could potentially be the biggest drop since a 9% drop in reaction to their second quarter numbers in 2023. But we'll keep digging in here and see what exactly is going on.
All right, so listen, I'm going to get to this article, and we're going to read a little bit about Starbucks, and then I'm going to talk a little bit about what I think about Starbucks as far as what's happening with this stock and with this company.
Well, if you're curious about getting into
Nope, we're going to go to this article here. All right, so listen, Starbucks has had it pretty rough, all right? Starbucks has had it pretty rough, and I'm going to go into this article and just read a couple things here from Morningstar. Says Starbucks stock has been on the up and down ride for the last 5 years. I told you all that before we got started. And its most recent slide lower may be leaving investors with a bitter aftertaste. Again, I sold Starbucks. I had Starbucks. I owned it. about 3 years ago, and ended up selling out of my position because I realized that the stock just wasn't doing what I thought it was. I initially acquired Starbucks as a growth stock, and it wasn't growing. And from everything that I was seeing, I wasn't seeing anything that showed me promising returns coming future, and I didn't like their dividend. The dividend wasn't lucrative at the time. I just felt like that I could put that money to better use somewhere else in a different position. So let's keep reading. Starbucks stock price down 20% in 2024 alone. Jesus Christ. With most of the decline after the company's downbeat earnings report on April 30th. Since then, the stock is down roughly 13%. At $76 per share, Starbucks is trading essentially where it was in May of 2019, which means that if you bought this stock all the way back 5 years ago, if you bought Starbucks back 5 years ago in May of 2019, today you would be no better off than you were when you bought that stock 5 years ago. That is concerning. That is a loss. All right. I don't care how you put it. I don't care how you want to, put it out, how you want to look at it. A stock not growing and essentially being where it was, its share price being where it was 5 years ago, means that you have 5 years worth of loss in terms of growth performance. All right. Says the culprit for the most recent sell-off is an unexpected significant decline in traffic at Starbucks locations. We'll get into that in a second. Analysts and the company's management were caught off guard by the magnitude of the decline, and they're trying to piece together the likely explanation. He cites building pressures on household budgets for lower income consumers like student loan payments, higher rents, higher insurance premiums, and inflation. We're seeing a pressured low income consumer shuffle spending toward other priorities. And of course, that is exactly what I was going to get into. Listen, the economy is in shambles right now. I don't know how simpler they can put it when they're talking about they're scratching their heads and they're looking for an explanation as to what's going on. Well, ladies and gentlemen, I just don't think that it's a very lucrative decision for people to get up every single day and before they go into work, they go and spend $10 on one drink every single day. Not to mention if you're getting something else besides coffee or besides whatever your drink of choice is in the morning. Because people are going there, they're getting donuts, they're getting, little pastries or whatever it is that they're getting, sandwiches, whatever. But I don't think that in this particular age, in this particular era where Americans are seeing more debt than they ever have before, they're seeing higher prices at the grocery store than they ever have before, they're seeing higher rent prices than they ever have before, they're seeing high car prices and car notes and housing costs. All of those things go into why Starbucks is seeing a decline in customer traffic. Simply put, Americans don't have the money. Where are they going to get the money from? People are having to find ways to cut their budgets, to cut their spending. And a $15 trip to Starbucks every single morning, Monday through Friday, might just be one of those cuts, right? It's not rocket science here. This is not rocket science here. This is what happens when the economy is on a downturn financially and the consumer base is in shambles. And Americans are facing a decline in revenue. They're facing a decline in raises while facing an incline in everything else. This is what happens. It's not rocket science to figure this out. Says Starbucks, the largest specialty coffee retailer in the world, isn't alone in hitting a tough patch. Dunlop notes that across the United States, restaurant traffic has declined for almost 24 months. But while there are plenty of exogenous pressure, and variables one could point at, nothing definitive would suggest this should have been the quarter when Starbucks saw its traffic fall off of a cliff. Starbucks reported fiscal second quarter sales of $8.56 billion and diluted earnings per share of, 67 cents. Well below Morningstar's estimate of $9.43 billion in sales and an EPS of 88 cents. Dunlop says that shortfall was driven predominantly by underwhelming comparable store sales. He explains that weekday afternoon sales, which are less habitual and skewed toward occasional customers, and weekend traffic were hit particularly hard. Yeah, I bet they were. Why? Because Americans are cutting the fat. It's time to trim the fat. It's time to cut the fat, y'all. That's what happens when we're in survival mode as an American. When you're in survival mode and you're facing tough times economically and financially, what are you going to do? You're going to start making the cuts that you know that you can do without. Streaming services are going to get cut. Your daily trips to the morning coffee, whether it's Starbucks or McDonald's, those are going to get cut down. Your daily eating out at lunchtime, that's going to get cut down. Right? You might start taking your lunch to work 3 or 4 days out the week and maybe just splurging on that Friday, right? That's what we do because the economy calls for it. Your finances call for it. Before we get, I'm not going to read the rest of this. Actually, I'm going to go to my favorite place to go. If you've been following me, you know that I love stockanalysis.com, free website to look up any stock and research. They've got all the financials there, the statistics. They got a forecast. They've got your dividend profile. They've got the history. Everything is here that you need. Stockanalysis.com. Do not overlook your free resources and tools, okay? So I'm here on stockanalysis.com. We've got Starbucks pulled up. You can see it here. 5 years. Over the course of the last 5 years, you're actually down 2%. So if you bought this stock 5 years ago, again, you have lost out on capital gains. You've lost out on growth potential when that money could have been invested somewhere else. Now, of course, I understand that hindsight is 2020, right? Hindsight is always 2020 because it's easy for us to look back on that data now and say, well, it was a mistake investing in Starbucks. But at the time, you could have been thinking, well, Starbucks is the number one chain in the world, number one coffee chain in the world. They're not going anywhere, right? Right? That's the typical thinking. They're not going anywhere. Number one coffee chain in the world. Nobody's going to stop getting their coffees and their lattes in the morning. Right? But in hindsight, looking at the data, it shows that we were wrong. We were wrong. Again, I sold out of my Starbucks position about 3 years ago. At the time, my reasoning for selling out at the time was that I just thought that money could have been allocated somewhere else and been more beneficial to me. Let's go over to the forecast. Again, this is just a forecast of regular people like you and I who look at stocks and they guesstimate. Keyword guesstimate. They guesstimate where the different highs and lows are. But let's read it. I like to look at it because I do find it interesting. So it says 20 analysts with a 12-month price forecast for Starbucks stock have an average target of $97.15 with a low estimate of $80 and a high estimate of $150. So they're thinking the high estimate for this stock could get up to $150 with a low estimate being $80. So it's $5 below their low target, which makes this according to them, a buy. All right. They're saying it's a buy right now. They're saying that in other words, they're saying that it's undervalued. And they may very well be right. I think that Starbucks has been hit a little unfairly. The market sentiment and the buyer sentiment in the market has been a little unfair and unjust, I think. But again, we're seeing the reflective results of the economy bearing down on the average American and their finances. So this is what you get. This is what you get. I always tell you all, okay, that along with the financial reports that we're getting back, right? Along with the outlook of the company and the results from the quarters that we're getting back, along with the meetings and the earnings calls, along with all of that data, you have to factor in consumer sentiment. You have to factor in consumer sentiment. All right? You have to factor that in. It's a mistake not to do that. It's a mistake to only go off of the financials. How do people feel about the stock? How do people feel about this company? Prime example, It's Alibaba. Alibaba right now is considerably undervalued in my opinion. Considerably undervalued. But again, it's not about their financials because they're making money hand over fist over there. Alibaba is a giant over there, okay? They're making money hand over fist, but at the end of the day, it's not about that. Why? Because the consumer sentiment surrounding Alibaba and the company is in the gutter. It's in the gutter. Investors, for the most part, are showing that they're out on Alibaba. They look at Alibaba as a risk, as a high risk value play. High risk value play. Prime example of why you need to take into account the news. Why you need to take into account the consumer sentiment, how people are feeling about a stock. So I think that is what is happening with Starbucks. I think Starbucks is getting a little bit of the Alibaba treatment right now. I don't think it's as bad as Alibaba, and I do see this company still being around, of course, over the next. I think Starbucks will be alive 100 years from now. I do. I think they'll be around 50 years from now. I do. However, you have to assess if that's a risk that you're willing to take for you and your portfolio. For me and mine and my dividend portfolio, not so much. Okay, not so much. Speaking of dividends, let's take a look before we get out of here. Says Starbucks has an annual dividend of $2.28 per share with a forward yield of 3.02%. The dividend is paid every 3 months, so quarterly, and the next ex-dividend date is coming up May 16th. That's 2 days from now. All right. And if you want to go down here, you can see their dividend payouts. They have been increasing. I'll give them that. They have been increasing their dividend payouts. All right. Since 2014. They've been increasing their dividend payouts. So that's something. Right? So for those of you who have owned this, you have been getting steady dividend raises and increases. So that's something. That's a plus. Look at that chart right there. That's typically what you want to see. So it's not all bad. It's not all bad. It's not all bad at all. If you own Starbucks or if you're looking to get into Starbucks, listen, right now may be a prime time. Right now may be a prime opportunity to buy into Starbucks while it's considered undervalued. The dividends are steady. They're growing. It's stable. This is a company that'll be around for a while. And listen, you know, what you gave up with growth and stock appreciation over the course of the last 5 years, you've been rewarded with dividends and increases in those dividends. But you all let me know what you think down in the comments. This has been Play of the Day. And I will see you all in the next video later.